to talk about something called the liquidity discount. Liquidity is one of those terms thrown around, and most people don't really understand what it means. What people normally think it means, or what they think you're talking about when it comes to liquidity, is the ability from an investment standpoint to get in and out of that investment relatively easy. So for example, if I buy $100,000 worth of shares in your business, can I then sell that $100,000 worth of shares either today, tomorrow, within a week, within a year, or is it going to take me 10 years, for example? And the problem really with most small to medium-sized businesses is that the answer to that question is normally that it's going to take a fairly long time to get liquidity on that position to basically be able to sell and exit those shares. And so because of that, there's something called a liquidity discount. And when you look at valuations that businesses trade at, you'll see that businesses that are liquid, basically businesses that are listed on a stock exchange, tend to get higher valuations opposed to those businesses that are illiquid. Illiquid businesses being private companies. And how do you make a business liquid? Well, either it's a big business and there's a market for its privately held shares, or it's a big business and there's lots of people that are interested in buying it, or it's a publicly listed company where the shares are traded on either a multilateral trading platform, which is basically a secondary market, as it's called, or a main stock exchange, a publicly listed company. And what you'll often see is that if you look at a really large public company and then its private equivalent, there can be quite a big disparity between those two valuations. In fact, you could often have around a 30% difference between a large public company and its private peer. That's absolutely amazing when you really assess it. Now, what's really interesting is if you then look at a small private company in the same sector, that company could only be worth 10% of the value of the public company. So you could have a large public company listed at 30 times earnings, and a small private company would probably be only valued at about 3 times earnings. And when you really take a step back and assess that, it's quite amazing that a company doing 1 million in profit could be worth 3 million as a private company. But that exact same company, if listed on the stock exchange, can be worth $30 million. This is the arbitrage between private and public. And that's really a combination of the liquidity discount plus the scale. Because with scale comes a larger audience of people who could potentially buy that business or buy shares in that business. And that really boils back down then to supply and demand. Because when there's an excess of demand, price goes up. And so larger companies have more demand, more people that can buy them, more people that want to buy them. So as a result, price increases. And a lot of people, I think, understands the basic principles or the economic principles, but very few people actually have translated that into the world of small to medium-sized business to really understand the arbitrage that actually exists between small company valuations and large public company valuations. Because it's quite simple. If you can turn a number of small private companies into a large public company, then you can benefit from that uplift in valuation, that arbitrage in valuation that actually exists between those small businesses and their larger peers. So, if you're interested in potentially rolling up your industry and receiving one of these large public company valuations for your business, then reach out to us here at Alliance Group and we can jump on a call to discuss.